Hey, good evening, everyone. Jim Cruzan here. Hey, happy Thursday. We're going to spend a little bit of time this evening talking about the fiscal cliff. I monitor very closely incoming phone calls, incoming emails, and noticed that there were quite a few calls about the fiscal cliff, and I certainly can understand why. It seems like the moment the election was over, I immediately went to the CNBC website, and 4 or 5 of the leading articles immediately started talking about this panic cliff and where we are. The agenda is really pretty light from the point of view that there are only a couple of discussion points, and I want to go into some detail on those discussion points. I want to talk to some degree on what this fiscal cliff is all about, what the components are. We hear about fiscal cliff. It's not one item, obviously. It's a number of items. And I want to discuss, what the big concern is, what everybody is worried about with respect to the fiscal cliff, and kind of peg probability on what, in fact, could happen and what that really means from the standpoint of the economy and whether this causes a recession or not. And then my hope is to refocus our attention on the bigger picture, which is, what the intent of this money is, and that is to provide for you for the rest of your life, which is far more important than the ebbs and flows over a very, very short term. And last but not least, I'd like to close with a couple of suggestions in terms of year-end tax planning, although I want to preface this by saying this is best guesstimate, obviously, as Congress horse trades with the President. We may find that some of these tax planning items maybe won't be quite as efficient, but these are some things that I'm certainly looking at utilizing this year myself, and wanted to share those with you. Components of the fiscal cliff. This whole topic, this concern, really is 4 separate issues. The first is we've got the expiration of the Bush tax cut, and that has to do with not only the tax rates, but also the estate tax rates, and then also, to some degree, the alternative minimum tax, although that's been an annual issue since 1967 or 69. Every year there's been a Band-Aid or a fix with respect to that. Then we'll talk about the sequestration, which is simply the forced reduction in spending, Obamacare, and then last but not least, which isn't getting a lot of talk, is this debt ceiling issue. Again, we went through the same thing last summer, and the government has enough funding to last through the end of the year and sometime into February. So there will certainly be some discussion on that as well. With respect to the Bush tax cuts, they were expected to expire well over 2 years ago, 2010. They've been extended the last 2 years. Right now, the tax brackets range from 10% right up to 35%. And we have 6 current unique brackets. If that Bush cut were to expire, we go back to 5 brackets, the lowest being 15% and the highest being 39.6. Now, a couple of interesting points is we go from 2 brackets that exceed 30% to 3 brackets that exceed 30%. And the minimum bracket is now 15 as opposed to 10, or essentially a 50% increase. The expiration of the Bush tax cuts, as it stands, would impact significantly middle class. Another thing that will be changing would be other tax provisions. Capital gains go from 15% as it is today to 20%. And ordinary taxable income, or ordinary dividends, would be treated as ordinary income. So that goes from 15 today to whatever the highest rate is, which could be, with Obamacare, something north of 43%. In fact, this last one, the dividend issue, is getting a lot of play. We're beginning to see some volatility among high dividend paying stocks. Some people are selling some dividend paying stocks going into next year. I sort of look at it this way. With a good paying dividend stock, I'm getting an dividend yield, which effectively is significantly higher than I could get in money in the bank. Dividend has the ability to grow its cash flow and dividend over time. And yet with the expected tax brackets next year, the worst case scenario is I'm paying taxes on dividends at the exact same rate I'd be paying taxes on interest if it were earned at the bank, yet I'm getting a higher yield, greater growth potential, etc. So I suspect that a lot of folks who are selling dividend stocks today, in the event that this ordinary income rate comes in a bit as a result of some negotiations and discussions, may be sorry that they actually sold prematurely here. In addition to the tax breaks with the Bush cut, we also have a number of other non-tax bracket issues that go away. The temporary 2% reduction in Social Security tax or payroll tax reduction goes away. Earned income tax credits, child tax credits, and the American Opportunity Tax Credit, all related to families, reverts to much lower, older limits, meaning less money to be applied as a credit. Also, student loan deductibility is severely mitigated as well. These items all impact middle class. Other breaks that go away, estate tax, this is certainly impacting the wealthy. Current rate is 35%. That's maximum rate on an estate. That would go potentially to 55%. But more importantly, all the while that rate is increasing, the size of the estate that would be considered includable or targeted by a tax rate would drop, meaning more and more estates would be included in the tax. The excludability drops from 5.1 million to just simply 1 million. So somebody who has a $2 million estate would pay no estate tax today. Tomorrow or next year, they could have as much as $1 million of those estate dollars taxed at a tax rate that could be as high as 55%. The last issue is the alternative minimum tax. There's a lower minimum tax exemption amount. Read that another way, there will be more income that potentially could be exposed to alternative minimum tax. This estate tax issue looks like an item that could be negotiated or reduced somewhat. The alternative minimum tax, every year we run up to a alternative minimum tax problem, and every year it requires a tax fix or a band-aid. And part of the reason for that is this thing was established many years ago, 1969. In 1967, there were 155 people that had incomes at that point well over 200,000 that paid no tax. Congress said this can't be, and they established alternative minimum tax. They didn't index the tax. So today, if it were indexed, that same 200,000 in 67 would be equivalent to $1.2 million today. Every year Congress has to put a patch on the alternative minimum tax to prevent more and more households from being included in the alternative minimum tax. There's a lot of dialogue about fixing or eliminating this. In fact, one of the proposals is the Buffett rule, and Buffett is talking about potentially establishing at some income level, call it $1 million, a minimum federal income tax, call it 30%. So at $1 million, the tax bracket would be 30% or higher. But if it was less, you would have to pay the minimum tax of 30. It becomes by default the tax bracket at that point. That may in fact do away with the alternative minimum tax. Another aspect of this cliff is the automatic spending cuts, or sequestration. If you remember, this sequestration came into effect because of the ineffectiveness of the Deficit Reduction Supercommittee last year to reach agreement. And the game plan was, in the event they didn't reach agreement, it would force some mandatory cuts in budget. And the fact that they didn't reach agreement, they triggered $1.2 trillion in cuts. And that's what you hear in the news. But the reality of it is, as is typically the case with the government, those aren't immediate cuts. These are cuts that are graduated and spread out over a number of years. In fact, for 2013, the total number of cuts is $109 billion. Now, $109 billion is about 0.6% of GDP, not a big number. And it's generally equally split between defense and non-defense spending. But here's the problem. On the non-defense side, Social Security, Medicare, etc., to a large degree are exempt. So these cuts that are automatic, which apply to non-defense spending, will probably hit more severely education, transportation, and energy. Because of this, Congress is trying desperately to avoid this. Now they can do that by extending, they can do that by modifying, they can do that by saying we're going to leave everything as is and punt for a year or two. But this cliff, as a result of the mandatory cuts, impacts GDP fractionally. Obamacare, or the Patient Protection and Affordable Care Act. There's a set of separate taxes that affect this. On almost every source of revenue, there will be a 3.8% higher tax. This is typically for people with incomes over $250,000. So if you're in the highest marginal tax rate of 39.6, that now becomes 43.4. If you have a capital gain of 20%, that becomes 23.8. And dividends, which are the same as ordinary income, highest rate 39.6, becomes 43.4. There is some expectation that these will get adjusted and horse traded. One issue that's going to impact a number of folks, and certainly has the ability to impact future planning decisions, is simply the fact that the adjusted gross income floor is being raised for itemized deductions, especially on medical, from 7.5% to 10%. So in other words, if non-reimbursable medical expense does not exceed 10% of your adjusted gross income, it's non-deductible. This makes HSAs, flexible spending accounts, and other types of securities that much more, or other types of vehicles that much more important. For a lot of our clients, we've been sharing the idea of using Roth IRAs, which are tax-free distributions, or HSAs, where you can build it up as a spending account and use it as a tertiary savings account to be able to withdraw tax-free in retirement, as a vehicle to be used for the purpose of providing for medical expense, deductibles, copays, non-reimbursable medical expenses, premiums, etc. Another change with respect to Obamacare affects the purchase of over-the-counter drugs and paraphernalia, which is now covered under both flexible spending accounts and HSAs. They won't be down the road. So in the future, you'll have to out-of-pocket expense those items. And then it also eliminates the reimbursement for flexible spending accounts to $2,100, making the HSA where available that much more attractive. Additional cuts, some of which seem a bit ludicrous. There's a 10% indoor tanning excise tax. I don't know if that's something that you as a tanner or your tanning provider is required to pay, but certainly tanning prices will probably go up as a result. And it eliminates the deduction for Medicare Part D expense. We had a chance to look at Medicare Part D, and that's primarily prescription, so I believe the prescription costs are no longer deductible. The last item that's really not getting a lot of news at this point or traction, and maybe that's because it's still several months away, is the debt ceiling issue. We're getting close to hitting our borrowing limit of $16.4 trillion, and again, that should be reached sometime in February. Probably closer to the end of February. One of the questions is whether that'll be negotiated separately or as part of this whole fiscal cliff. And if you remember, this whole sequestration issue that we just went over is a direct result of the fact that the debt ceiling issues didn't get resolved on time, and they went right to the brink and kicked in the sequestration provisos. One of the big concerns, all of this melded together, is simply tax mitigation. It's a mess, and a lot of people are really worried that this is going to cause a horrible reduction in GDP. I'd like to spend some time kind of talking a bit about that. Here are the factors that contribute to the fiscal cliff. As you can see, affordable health care is a $35 billion issue. Extending unemployment benefits is a $30 billion issue. Mandatory spending cuts is about a $100 billion issue. Expiration of that 2% payroll tax is 120. And the Bush tax cuts, all in, is 180. If we added everything up, and if everything bad that could happen to all of these things happened all at the same time, it would be about a $650 billion reduction to GDP, or about 4.1%. If all things bad happened and all bad things ran to their fullest extent. The big concern, obviously, is if there is some reduction in economic activity, what impact is that going to have on GDP? And that's the fear factor. That's where everybody is, and everybody looks at the potential problem, and they look at what happened in 2007 and 8 with the credit crisis, and they say, we're going to get what we got in 2007 or 8. I'm here to suggest that that's not the case. I'm here to suggest that 2007 and 8 was particularly violent with respect to markets and assets, because of the issue with leverage and the fact that many of these financial vehicles were highly leveraged. We took a lot of leverage out of the system. Today, the economy is different. Corporate balance sheets are healthier. Individual balance sheets are healthier. And there's far less leverage in the system. So we probably wouldn't get the same knee-jerk reaction if everything bad that could happen happened all at the same time. PIMCO did a study just before the election, and they looked at all the various mutations of the election, who wins, what does Congress look like, what's the makeup, and what's most likely to happen with respect to the cliff and some of this horse trading that goes on. And they suggested if everything bad happened, it would be about 4.5% of GDP. The slide I just showed said 4.1. There's some rounding error depending on the source you use for the data. But here, the second column, where you have Obama as the president and a split Congress, they're looking at, again, best guesstimate as to what probably would happen. For example, they would extend tax cuts for those under 250. They would cut, or there would be no extension to payroll tax cuts. There would be no extension to unemployment insurance. There would be some reduction or repeal of the sequester for defense as well as non-defense spending. Anyway, their expectation is it may have a 1.7% impact on GDP. GDP has averaged the last 20 years 2.5%. Since the market bottom and subsequent recovery, we've averaged something north of 2. Last year, or this year, we began the year with about a 4% GDP. The second quarter, and that's the most recent data that I have, we were at 1.3. The third quarter came in something north of 2, and the expectation is GDP is beginning to grow ever so slightly, beginning to see some improvement in manufacturing. We're beginning to see some improvement in housing, and the expectation is second half of next year, the thought was GDP would grow at something greater than 3%. I'm trying to find a slide that represents that. There was a slide earlier in the year from JP Morgan that showed just that. So it looks like the economy was expected to grow 2.5% to 3%, which is not unlike long-term average. Some people would argue that, look, if some of these uncertainties are eliminated, if we have a much better understanding of what the tax structure looks like, that would improve confidence, that would improve corporate spending, and that would improve GDP. That could happen as a result of the negotiation. But if it doesn't, we're potentially looking at a reduction in some cases of GDP of 1.5 to 1.7 on a base of 2.5 to 3. That doesn't signal a recession. If everything bad that could go bad and everything unholy happens, then you might see a shallow recession of 1%. Interestingly enough, though, if you look at the dialogue and consider the discussion, these days you're beginning to see some change. Even the Republicans are changing their tune, and they're now a little bit more willing to discuss increases in tax revenue while they're holding firm on discussions about tax rates. Read that as keep rates the same, increase taxes by reducing or eliminating deductions, and thereby affecting the wealthy more than the middle class. If you looked at tax cuts, not talking about deductions, but legitimate payroll cuts, there's about $260 billion of this total $700 billion of potential stimulus. There's only about 55 billion which directly impacts the wealthy as defined as AGI over 250,000. The vast majority of these cuts impact middle class. So it's important not to have the cuts expire. It's important to get to a negotiating table and start doing some horse trading. There have been a number of people, including Office of Budget, Management and Budget, that have put out some potential compromises. One is extending many of the expiring provisions, extending lower tax rates, but at the same time increasing tax revenues by eliminating deductions available to high-income households. If they can accomplish some of that on the tax side and then accomplish some other by cutting government spending, they can accomplish their long-term goal. So let's take a step back off the panic, and let's kind of look at where we are and how markets have been resilient in the past. Because really the fear comes from something bad's going to happen, market's going to react violently, and I'm going to lose money. Today, corporate earnings are as high as they've been. In fact, they're higher than they were back when the market peaked in 2007. But PEs today are a fraction of where they were in 2007. So as a result, markets are actually less stressed, more valuable, cheaper than they were 5 years ago. In fact, when you look at the market and you look at it from a PE, price earnings perspective, large cap growth stocks are 72% of the PE that they were averaging the last 20 years, read that as a 27.7% discount. So we're not at full value by any means. Yet we're gripped by these emotions of fear and greed. And fear is the one that seems to be taking hold today. Clearly we're not overconfident, swinging for the fences in terms of return. We're trying to go to extraordinary means to protect what we have over what may be a fairly short-term reaction of some degree. The credit crisis was a 5.1% negative GDP. We're talking about the potential of a 1.7% reduction to a positive GDP. We're not talking about apples and apples. The two are not the same. Stock prices can go up in a slow-growing GDP. A colleague of mine sent me this Dilbert cartoon, and I thought I'd share it with you because this is kind of what happens from the standpoint of thinking about items that we have, in some cases, no control over, and fear spiraling a bit out of control. So the one person is talking to the other, and he says, I'm worried that I won't get a raise this year. And his colleague says, you shouldn't worry about that. You should really worry about the fact that you might lose your job in the next round of layoffs. And the original fellow said, I should be worried about that. For what reason? Probably not. It makes more sense to worry about the entire company going out of business. In fact, that's nothing if the global economy collapses. Maybe we should be worried that the only viable livelihood of the future involves cannibalism. And then he's talking to, I guess, a pet who says, are you still worried about getting a job? And he decides not so much, faced with the prospects of cannibalism. I think fear builds up. The media clearly is not our friend, and as a result, they kind of drive home this fear, because fear sells, and we start believing in this, and some people take desperate action. Moreover, right now there's an awful lot of ads, brochures, books, which are really just veiled attempts to sell people a lot of gold and metals. Usually a lot of these quote-unquote research pieces are issued by companies that make their living selling gold and metal to others. I'm old enough to remember when I first started in this business, there was a very popular newsletter writer, Howard Ruff. He wrote a newsletter called Rough Times, which was very popular and had a huge subscriber base. This was during the 70s and then into the early 80s. And for a 10-year period, he was preaching inflation and protecting against inflation and hard assets, and had a huge subscribership. Those that followed that advice in the 80s did just horribly. Everybody bought into it. Everybody believed that this person was right. Buy gold, so to speak. And for the next 25 plus years, nobody made any money on gold and would have missed the complete bull market. And gold's been very popular the last 5 or 6 years, in part because of concerns over the devaluation of the dollar and the government and inflation. But it seems like whenever we get to a point where we're all believing in something, rarely does the general public get it right. And as a result, investors tend to be a bit irrational. They tend to be overly enthusiastic at exactly the worst time, at the time of greatest financial risk when prices are ridiculously high. And in times like this, when there's far less exuberance and more fear and concern and despondency, that's the time of maximum financial opportunity. Buy low, so to speak. The last couple of years kind of tells that. This red line up here, these red numbers indicate withdrawals from stock funds. Black line is deposits into bond funds. So the last 5 years, money's been pouring out of stocks. All the while the market's gone higher since 2009. And money's been going into bonds at a time when interest rates are at as low a period as we've seen in 70 or 80 years. As a result, the average investor tends to earn a very low rate of return compared to the return that's available on many asset categories. And the reason is they tend to get out at the bottom, they tend to chase hot stocks at the top, they tend to jump into areas of great popularity at the wrong time, and all these things hurt their long-term performance numbers. This is a difficult chart to understand, but let me share with you the green line, which represents the growth of $10,000, and the red line refers to dollars coming in and dollars coming out of the market. So effectively, what this is saying is that when the market peaked in 2007, there were huge inflows in the stocks. People were buying stocks at the peak, and at the very bottom, there were huge outflows. People bailed at the bottom. And since the market's been taking off, there's been nobody buying in. This 10-year performance, and this is based on mutual fund activity, the Dalbar study. The average performance of the S&P 500 during this period was 7.6%. The average return for a mutual fund investor during the same period of time was minus 19.4. Reason? They ended up buying really high instead of buying down here. This is based on flows, and they ended up getting out at the bottom and not getting back in to enjoy this. And you can see where the market has certainly recovered from a horrible drop over a reasonably short period of time. Let's look at the past for just a couple of minutes. And I'm doing this from the standpoint of what's the worst thing that could happen. I'm suggesting that the economy doesn't have to go into a recession. In fact, depending on the horse trading that is done, the impact to GDP could be quite slight, and with the expected GDP growth, it can still be quite positive and probably not that dissimilar from what we saw in the second quarter of this year. This represents 1973, which is a horrible period, high inflation right up through May. Here's the headlines in the beginning of 1994. Time magazine had several about world inflation. President Ford trying to fight inflation. And he was talking about inflation, recession, and oil. And the economy looked extremely sick during that period of time. And if you believe the headlines, you didn't do anything. Why invest? But that same money invested at that point in time would have grown through May of this year an average of 8.5%, or 1,962% in spite of this volatility. And if we reinvested dividends, it would have grown 3,600%, or 9.6% per year. Remember, the money that we're worried about is money that has to last the rest of your life. 1979, enough things out there to spook us. We were worried about OPEC. We were worried about rising oil prices and gas shortages. We were talking about a super increase to personal bankruptcies, etc. And yet from 1979 through that same date in May, the market increased 1,200%, or 9.5% a year, or 8.5% a year, and with dividends a little over 11%. And again, that's in spite of some severe reductions and pullbacks along the way. 1998 or 1989, same thing. We had a housing implosion. We had Fannie Mae closing on a number of homes. We had savings and loans failing. USA Today had a number of headlines talking about bank failures, savings and loans. That's where we had the Reliance Trust Company that was put in place to bail out these banks. And yet the market averaged 7% a year from 1990 to current, and with dividends over 9% a year. So what do we learn from the past? Markets tend to climb a wall of worry. You look at the headlines today, it's hard to believe that accounts are up 9, 8, 9, 10%. In March of 2009, they were talking about the end of the gravy train, so to speak, this huge economic crisis, and that was within a week of the market bottoming out and turning back around. In 2009, they were talking about $150 oil prices. Oil went from nearly 150 down to 30, and have come back somewhat. Just last year, we were talking about the recovery. You realize that the market since the summer of last year is up well over 25, nearly 30%, in spite of these scary headlines. Yet CNN Money did a consumer sentiment, investor sentiment poll, and it's the lowest reading ever recorded. Indicates extreme fear as opposed to extreme greed. You know, a big takeaway on this is sometimes dramatic headlines tend to indicate a great buying opportunity. And if we allow ourselves not to get emotional and take a step back, sometimes that helps quite a bit. Patience tends to work very well. The Great Depression, obviously a huge drop, and I'm not suggesting anything like that, and most portfolios today are structured much more conservatively than they were even in 2007. But it took very few years to recover from the market bottom. In fact, if you did nothing, it took 4 years and 4 months to fully recover from the effects of the Great Depression. If you bought more at the bottom, you recovered in 3 months. If you sold out of everything, you realized a 78% loss and never got it back. 1 year from the bottom, the market was up 137%. If you need the money tomorrow or need the money early next year, you may want to do something. If it's money that you don't need right away, it's long-term money, then invest for the long term. Make sure the portfolio is well diversified. This was the oil crisis. Same thing. Market dropped significantly over a 2-year period, and it was back up appreciably. Did nothing, took 1 year and 8 months to recover, bought more at the bottom, took 5 months to recover, sold out, it was a 44% loss, and it recovered 44.5%, let's say, in 1 year from the bottom. Generally, it doesn't take decades to get money back. It takes much, much less time than that, and it's bad math to think it takes decades for things to recover. And again, I'm assuming worst case scenario, full degree of some horrible drop. We use a globally diversified portfolio. The portfolio has far less equity exposure than the S&P 500. And as a result, it tends to lose less money over longer periods of time because it has less stock exposure. Not that it can't go down in value, but if you have something that generally has less stock exposure, some bond exposure, exposure to commodities and other types of assets, you generally will suffer less of a drop. You'll have lower highs, but the portfolio itself will generally be less volatile in nature. Not that it won't avoid a drop, but it generally will reduce the degree of the drop. One last thing I want to mention is just year-end tax planning. And again, it's going to be very, very difficult to do this because we have no idea if things get resolved before the end of the year or not. And more than likely, if they do get resolved, they're going to get resolved very close to the end of the year. It might be difficult to do some things. And some of this is a leap of faith to the extent that I think some issues go away. I want to take advantage of them now. This year, 2012, as opposed to next year, I would accelerate any income. If you've got some deferred comp and it's coming to you next year, but you have the proviso to take it this year, I would take it. If you are an independent contractor and have billable income and can submit an invoice and get paid this year before December 31st as opposed to have it hit January, might make sense because we may see some impact on tax rates. Complete large financial transactions, if you're selling a building, selling a business, you might want to do that this year. I know a couple of colleagues that are quite a bit older than I am entered into a sales agreement this year to sell their advisory practice and to stay on as a paid consultant because they wanted to ensure that their capital gains rate would be impacted at 15% as opposed to something higher. That's a large financial transaction. You may want to accelerate some tax deductions this year. Prepay mortgage interest if you have the ability to do so. Maybe prepay local property tax. Expedite medical procedures. Remember, this year, 7.5% of adjusted gross income, and you can deduct medical as a tax deduction. Next year, it's 10%. So if there are a couple of things that can get done, tomorrow morning I'm having semi-annual visit with my dentist. I was going to do that in January. I'm pushing that ahead for that very same reason. Gift appreciated assets to family at a lower bracket. If, as an example, you were to give money to the children and you could give an appreciated asset and they could then sell at a lower tax bracket than you would sell to come up with the cash to provide them, it might make sense to do so. Significant charitable gifts, large charitable gifts, you might want to conclude this year because there's a chance you'll be able to deduct more of it. Understand that a lot of deductions will face scrutiny by lawmakers, and some of these deductions are already reduced by AMT. So if you're unfortunate in that you trigger AMT, you've probably already lost some of those deductions. But if you haven't, it might make sense to look at accelerating some of those things. And the other thing is with respect to capital gains on stock. Again, IRAs, doesn't apply, but in a taxable trust, it might. And my thought is this: if we know we're going to spend money next year, and the likelihood is it's going to come out of a trust, we might want to consider pruning or selling some of those positions before the end of this year, because the expectation is capital gain rates will go up. Now, what's the worst thing that could happen if we did that? The worst thing would probably be that they decide to postpone the rate hikes another year, in which case we could have delayed the capital gain and we could have realized it next year, but we're not eliminating the capital gain. It would have to be realized. So by doing it this year, it provides the capital that we need for next year, and it assures that we're probably getting taxed at a lower rate. As far as tax losses, I'm more inclined to use the tax losses next year as opposed to this year. Now obviously if we have gains this year and we really don't want to pay the gain, we can soak up some loss. But if we wind up with excess loss, not a bad thing, because next year the excess losses will be worth more because they'll be offsetting a higher capital gain. So that's the thoughts on that. With that in mind, I want to thank you. Again, the takeaway is we're going to have a lot of nervousness. The markets are going to swoon and they're going to soar depending on bullet points and talking points, probably between now and maybe this time next month. It's generally short-term in nature. Moreover, if everything implodes, it's going to be a shock of maybe 4% to GDP. That's 4% to an existing GDP of 2.5 to 3, so we're talking about some slight reduction. Maybe that means a recession. The market is already trading at a significant discount to historic PE. The reason has a lot to do with this wall of worry. In the event that there's some compromise, whether it's done this year or early next year, it doesn't mean that once we go off the cliff, it means a 4 or 2% reduction to GDP. That would be if that remained in place for the full year. If they get their act together a month into the beginning of next year, it may not have any impact to GDP. And the likelihood is there will be horse trading. There will be some reduction in the impact, and the reduction may cause the reduction to GDP may be low enough that we actually still have growth in the economy that's pretty equivalent to what we had in the second quarter of this year. With that in mind, I want to thank you. If you have any other questions, please let me know. My expectation is I'd like to hold more of these sessions throughout the year as things come up. This one I had to put together very quickly. I would expect other sessions that I have will have a higher production quality. That being said, I wanted to make sure I got it out because I did notice a heightened degree of concern over Fiscal Cliff. Once again, thank you. If I don't talk to you directly, Merry Christmas. Have a Happy New Year. And if you need me, I'm here. You know where to get a hold of me. Talk to you guys later. Have a wonderful evening. Good night.